is called Inflation Arithmetic. Hopefully, this is a quick one. I got some charts. I'm going to talk about the gold price, the money supply, the GDP, the Dow, maybe some other stuff. Here's the first chart that I got from inflationdata.com. And what it's showing is, among other things, is that the inflation, every so often, the trajectory of it changes. Now, here's where the Fed was created in 1913, and for about 7 years it went on a tear upward, and for 20 years it tapered a little bit. It's the only time it did that. And then here, these are more or less straight line runs. For 30 years, it continued that trend. And then in 1971, till now, for about 50 years, 1971 is when we ended the gold standard. That bumped this up. And that's, as you can see, that's a real straight line. And because this chart only goes to 2015, I think it's very reasonable just to extend that a little bit and just eyeball it, because I'm not doing anything exact in this video. So that's about 2,500. And then I make a little calculation here. I say, the difference between now and 1971, when they ended the gold standard, which is the time period that I want to focus on, the interest, the cumulative inflation rate was 2,500% minus 300%, which is 2,200%, and we get a little. 2,200% is 23 times. So I take that number and I say, what if I applied that to a gold price that seems reasonable? I'll show you where I got this on the next sheet. And I come up with a range for the price of gold of about 2,600 to through about 4,200. And that's the price as it is now in 2021. So that's the price, right up here. And one thing, if we keep on extending it, this direction, but it does kind of look like we're in an inflection point where we might be starting a new trend after 50 years where it takes off at a little bit of steeper angle. So the rate would increase. Anyway, all this is just opinion and speculation. So just a disclaimer there. And here is where I got the numbers. I just grabbed a low number and a high number so I could get a range. And you'll notice that gold is, it's a little higher. It's about 1,800 right now. And what I'm saying is that, it could be, somewhere in this range right now as we speak. That's what I'm speculating with that is that point right there. And I'm still saying that what it's going to, in a few years, 3 or 4 years, it's going to that number. I'm still saying that. This is just what it could be right now. And so I was going to look at the money supply. That's what M2 is. And you can find this graph. If you Google Fred and you Google a money supply, M2, you're going to find it. It's a government website. And so I've got a calculation that I went and grabbed the numbers Right now, 2021, November, we're at 21 trillion, and in 1971 we were at 0.7 trillion. And if you do the math, that's the delta, the difference. Later on, I use the ratio. So that's 21 trillion. And here is the gross domestic product. And you going and hovering over the endpoint, I get 23 trillion. And in 1971, I get 1.2 trillion for a difference of 21.8 trillion. And I want to point out something that I'd heard somewhere, that from this guy right here. And I thought it was astonishing, amazing. This guy's really sharp. So I don't doubt it's true, but it just seems like crazy talk almost. That the M2 and the GDP are actually the same are essentially the same thing. If you Google him and you Google GDP, money supply, I think you'll come up with some of his articles. His articles aren't easy reading, but it's worthwhile to read it. It's fascinating to me. He's an actual economicist, economicist. That's the word for it. And my background's engineering, so I'm just kind of a hack at this. But my calculation certainly, for the GDP, these two numbers are essentially the same. And in terms of the delta, the change, what he said, I believe, he said that the change in the money supply at any given point is equal to what the GDP is. Supposedly they discontinued that, but I don't know that, because here I am. There's that point right there, and they've got this graph. But if you Google the money supply, you will find reference to it being discontinued about a decade ago. So I find that very interesting, and so the GDP is just the money supply, literally. Now, if I take the money supply and get a percentage or a multiple, and I say, and apply that to the stock market, so instead of doing the difference, I do the ratio, and I say, well, the money supply increased by 30 times from here to here, just doing that arithmetic, real simple. And you couldn't say that the difference went into the stock market. That'd be ridiculous. But if you make it a ratio, you could say, well, did the stock market go up 30 times? Did that have an effect on the stock market? And I use the Dow, because this data goes back further. The S&P might be more appropriate, but I've always used the Dow and just assumed the S&P would behave similarly. And if I go look up in 1971, this is from Macro Trends, by the way. It's a great charting website. And I just take 1,000 and multiply by the 30 times. I come up with 30,000, which is where the stock market was not too long ago. But it's continued up to 36,000. And so I'm going to do some arithmetic with that and just speculate. This is all speculation. I like to speculate. That's what I do. That's what I'm doing with mining stocks, is speculating. So here I'm showing some arithmetic that makes the argument that of the 36,000 where the stock where the Dow Jones Industrial Average is approximately today, 30,000 of that is due to the money supply, and presumably 6,000 would be due to hey, over time things tend to get valued are more valuable, and so I took the 6,000, the 1,000, and that adds up to 7,000, and I plotted that point right there. And indeed, the trajectory that the stock market was on, that seems like it would be almost come out right exactly there. So if there was never a Federal Reserve, I'm just speculating here that that might be what the stock market value is. And if we were to quit printing money, which right now we're talking about tapering, which is it's still increasing the money supply every month. It's just by not as much. But they're talking about gradually reducing that down to where they're not increasing the money supply at all. Then I would think that the stock market could fall down to that value and gold could rise up to that value. So in a way, that's another prediction for the price of gold, 7,000. Because Dow, in all my other videos I talk about this, but the Dow gold ratio is headed towards 1. And indeed that's my next chart, right here, this is headed towards 1, like it has done in the past. And it's actually 1's a conservative number. It could, if it follows the trend that it's set up, it's going below 1. So that's a possibility. And here I want to call to your attention what I've highlighted in yellow, and this time period. These have parallels in what I'm doing, what I'm using as a signal to get into gold or money. And in the late 70s, we had stagflation, and it looks like we're starting into a time period of stagflation right now. So I put a question mark there. It's speculation. So if I go to this chart, which is the CPI plotted with the Bloomberg Commodity Index divided by the S&P 500, and you'll notice how well they correlate, especially when they're up on the graph like that. And this time period right here is the stagflation time period that we're talking about. And stagflation, I think, is characterized by, one thing it's characterized by is it has time periods in which the 10-year treasury is less than this CPI number, because the CPI goes up so fast that the 10-year treasury can't keep up with it. And therefore, people are earning, think of the 10-year treasury as dollars where you earn an interest rate. Well, if the 10-year treasury's 2% or 1.5, whatever it is, and this is 6 or 7%, then you're earning negative 5%. Because your money's losing value. When cash is even worse. You're losing the change is negative 5%. But if you have cash, over time, cash is going to be negative it's going to be the negative 7%. And what I'm saying is that we just started with that spike right there. We started, and that could go a lot higher. It could go off the chart compared to over here because they had the capacity to raise interest rates back then. So I think I've done that on the next slide. I calculated a gold price based on the CPI. And I just eyeballed this. I said that is about 13.8, call it. Yeah, that's what I did. So that number is where the 13.8 comes in. And see if I can get this on the screen here. This column is CPI, and this column is the commodity index, which I'm not talking that much about. But the commodity index does contain gold, so you can see that when this takes off, gold should follow. It's a commodity. I guess what they're getting at here is that all commodities tend to rise when there is inflation, real inflation. And so far, gold has just lagged behind this for some reason, possibly because of Basel III, the rule which ends at the end of December. So gold could get some big legs here shortly. And let's see, what did I want to say? Oh, this number right here is in between 4 and 2, so that's right halfway in between it. So that's a 3. So just take that ratio, 13.8 divided by 3 times 1800, and I get 8200, which is in the ballpark of what some of the other numbers I've gotten. Actually, I kind of got a number right there, 7,000 right there. And what else did I get? Oh, and my old number has always been that number. And that'll about do it. Thanks for watching. Good luck.